Goodwill is an intangible asset that is created on the balance sheet with the purchase of one company by another. It represents the competitive advantage a company can get by buying another company, and its amount is the portion of the purchase price that is higher than the book value of the company being bought. The reasons that one company may pay a premium for another can be things like company's name, brand reputation, loyal customer base, and solid customer service, which all of them are not easily quantifiable. And on this video, we are gonna explain what it is, how it works, and how to calculate it. Before starting, I wanted to thank you for watching this video. I talk about finance and investing, so if you like what I do, please make sure to subscribe to my channel and tap the like button for the YouTube algorithm. It's free and it's the best way to support the work I do here. And now, without further ado, let's get into it. To understand Goodwill, let's start with an example. We have two companies here with their simplified balance sheet. Company A has 10 million of cash, 5 million of fixed assets like property, plants, and equipments, and 2 million of debt, which gives them 13 million of equity. Company B has 100,000 of cash, 200,000 of fixed asset, and 200,000 of debt, giving them 100,000 of equity. Company A wants to buy Company B for 500,000, while its book value is 100,000. So they are paying a 400,000 premium. Let's see how the transaction will work. First, 500,000 cash from Company A will be moved to owners of Company B, and now Company A owns Company B with all its assets and liabilities. Next, Company A moves the 100,000 equity Company B had to its balance sheet. And finally, Company A need to have the same equity as before the transaction. So they will record the 400,000 premium paid in cash on Goodwill account, and now their new balance sheet looks like this. If for some reason Company A pays less than book value for Company B, it gains negative goodwill, which can happen in a distressed sale and is recorded as income on the buyer's income statement. Goodwill is recorded as an intangible asset on the buyer's company's balance sheet under the long-term assets account because it's not a physical asset like buildings or equipment. Companies are required to evaluate the value of goodwill on their financial statements at least once a year and change them if needed. For example, when the market value of the asset drops below historical cost or estimated future cash flows discounted to the present declines, and this will be expensed as a loss on the income statement, which directly reduces net income for the year. The formula for calculating goodwill is fairly simple in principle. Just deduct the book value from purchase price. But it can be quite complex and costly in practice. So many companies will just amortize goodwill like other intangible assets annually over a number of years. Goodwill is a premium paid over fair value during a transaction and cannot be bought or sold independently. Meanwhile, other intangible assets like licenses or patents can be bought or sold independently. Therefore, at a point of insolvency, the goodwill will be ignored since it has no resale value. Also, goodwill can have an indefinite life, while other intangibles have a definite useful life. Evaluating goodwill is a crucial skill for investors. When reading a company's balance sheet, it's important to tell whether the goodwill it claims to hold is in fact justified. For example, a company might claim that its goodwill is based on the brand recognition and customer loyalty of a company it bought. Investors need to understand what is behind the stated goodwill in order to determine whether that goodwill may need to be written off in the future. Or the opposite, if you believe that the true value of a company's goodwill is greater than that stated on its balance sheet. So to sum everything up, goodwill represents a value like a potential competitive advantage that may be obtained by one company when it purchases another. It is the amount of the purchase price over and above the amount of fair market value of the targeted company's assets minus its liabilities. Goodwill is an intangible asset that can be related to the value of purchased company's brand reputation and loyal customer base. While goodwill officially has an indefinite life, it should be looked over annually to see if the value needs adjusting due to an adverse financial event. If there is a change in value, the goodwill account will be decreased on the balance sheet and a loss is recognized on the income statement. Thank you for watching this video. Hope you enjoyed it and learned something new. If you did, make sure to smash the like button, subscribe to the channel if you have not done so already, and tap the bell button to get notifications when I post a new video. Check out Simply Wall Street linked in the description and try their great offer. Have a great rest of the day and see you on the next one.